Hello everyone, my name is Reese, and in this video I will be talking about a topic that I believe is very important for pretty much anyone to understand, and that is the time value of money, and which in turn leads to why is it important to start investing early and often. And specifically, what I'm going to be diving into is I've created a spreadsheet that allows you to calculate compound interest returns using different contributions and time history to see what kind of expected return you might get based on different things such as holding it in cash, a high yield savings account, corporate and U.S. Treasury bonds, a blended stock portfolio, as well as investing into the S&P 500 itself. And now these interest rates are customizable for the specific calculator, but essentially it's kind of diving into calculated based on historical averages since the 1940s. So historically, the S&P 500 has returned at a historical interest rate of 9.5%. This can be greater. This can change throughout depending on the specific time horizon you're investing in, but in the long run, that is a running average. And then the 60/40 stock bond portfolio is basically the historical performance of investing in a blended portfolio of both stocks and bonds for a little bit more added stability. And then 5.5% is the average return of investing in bonds overall since the 1940s. And then high yield savings and cash. So cash, I'm treating this as if you're holding cash in like a checking account, so you're getting like a 0.1% interest rate, and then high yield savings of 2.5%. I will be uploading this spreadsheet so that if you want to make any changes to yourself or run any numbers on your own, you can do that. This calculator is based off of a pretty useful tool, which is on the investor.gov. It's a compound interest calculator, which is essentially doing the exact same thing, but this will allow you to compare multiple sources at once, and it's using the exact same equations and calculations, just in a different format. And then going back, now that that's a brief summary of what I'll be talking about, is the purpose of this is to show you why it's important to invest in the stock market if you have a long-term time horizon rather than just holding cash. Because specifically when we're looking at the time value of money, you really want to be, if you're not outpacing the rate of inflation, you're really not growing your money. So when you're holding cash in a checking account or wherever in a safe, wherever it is, that money is technically depreciating in value over time as the overall dollar inflates. Now, you can help kind of curb this by investing in a high yield savings, because historically the inflation rate's usually around 2%. So if you're able to get like a 2.5% high yield savings, you technically might be beating inflation marginally in the long run. And then stepping up from there is bonds. Bonds are a form of basically lending your money to an entity that is going to agree to pay you back at a fixed interest rate. And this can be in the form of the U.S. government, high yield bonds, corporate bonds. Basically, you can dive into the bond market or buy bond funds, but I will not be diving into that specifically. And then the S&P 500 or stock market as a whole is essentially you are betting on stocks or investing in stocks in the long run to get long-term gains. And historically, stocks have been the best performing investment type in the long run. However, they will be the most volatile, and in any sell-offs or recessions, typically stocks will take the most beating. So the higher interest rate you are getting from an investment product, typically the more risk that will be associated with it. When you're in cash, your only real risk is you losing that money or getting robbed, for example. And then same thing with high yield savings. It's kind of just on you. The risk is more on you. Whereas when you're investing in stocks, there's a lot more factors beyond your control that you really can just focus on informing yourself as much as possible, investing in quality funds or companies, and not just throwing your money in potentially something overly risky. So, with all that being said about what your investment options simply in simple terms are, now we're going to be looking into what those returns can look like. And a lot of people think that from what I've heard from talking to peers and friends and just what I've seen online, is a lot of people have this idea that they will start investing when they have more money, or the problem with that is that you may not ever get in a position where you think it's the right time to invest. And even as a famous quote from Warren Buffett is, the best time to start investing was yesterday, the second best time is now. So really, I think it's important to be informed about what your investment options are so that you can help create a better future for yourself, whether that's taking advantage of a company 401k, IRAs for yourself, HSAs, or even just managing your own brokerage account, investing in simple total market funds like VOO or VTI, which are S&P 500 or US total stock market funds, can be an easy way to set yourself up for success. And you really don't even need to invest ridiculous amounts. For example, if you're someone in your 20s and you have a decently long time horizon, oh, let me see. Even just investing $100 a month over 40 years can get you a balance of a little over half a million. Now that's not going to be enough to retire, but that's just starting with $100 a month. That's $25 a week. And if you're someone who's able to up that up a little bit up to, let's say, 200 a week, boom, now you're a millionaire in 40 years. And that is showing you that time is really on your side, because as soon as you start decreasing the time, your returns by investing in the stock market really start getting hurt in the long run. Because look at this. In 40 years, for example, you have oh, a 212% gain. I think I have an issue with my calculator. I have an issue with the calculator. I'd have to go back and fix it. Oh, that's why. It's not comparing it to the right what it should be. Okay, so stocks are beating the. Let me see. Okay, I fixed it. So stock market is beating cash holding in 40 years by over 10 times, 1,000% more gains by investing in the stock market rather than holding it in cash. And then bonds, you're getting 262% versus holding in cash. And keep in mind that this is the power of compound interest. Even though S&P 500 is, I say, only 4% higher than bonds, which is a little less, it's less than double, you're getting basically quadruple the actual returns, because that compounding will compound over time and you start growing a portfolio exponentially. So basically, what you can use this tool for is play around with numbers. Even if it's, something small, or maybe you're something a little more developed, you're able to do 500 a week or 250 a week. You invest 1,000 a month over 40 years, 5.5 million. And keep in mind, typically as you're getting older to retirement, you usually will start taking on more bonds or more less risky asset types. So you're pulling back overall on the overall stocks that you're invested in. But if you have a long-term time horizon, you really want to take advantage of stocks to its potential to help set yourself up for more financial freedom. Because if you're throwing your money into a cash account, you're not only losing money to inflation, you're losing the potential, because this is showing you the time value of that money, if depending on what you've done with it. So like, even if, say, I, I think it'll break my calculator if I put, okay, so we have an initial contribution of 10,000, $100,000, and we let it sit for 40 years. Okay, maybe you don't have, oh, damn it. So we have $10,000, and this is we're not putting any more money in. We're throwing, if we have $10,000 and we have 40 years, What can we do with it? Well, if we put in cash, it's not really going to go up in value. All right. If we put in a high yield savings, it will get us, it will almost triple over time, but that's still not really helping us. We put in bonds, we're getting a 900% return, which isn't the worst thing. So we're turning $10,000 into 90,000 if we had put it in bonds instead of cash. Now, if we put it in a blended stock portfolio, 233,000, and if we put it in the S&P 500, assuming a annualized return of 9.5%, we're looking at 440,000. That is with no additional contributions. I mean, even if you just take it down to 1,000, this is showing you that the time value of money, when you have time on your side, especially the longer time horizon you have, you can really start seeing some crazy gains when time is on your side. And because this is an exponential growth pattern, as the more time you have that your investment is sitting in the market overall, the faster your returns are going to compound, and you can start realizing those gains to help just set yourself up for that financial cushion. So really what I'm trying to show with this tool is that you don't need to invest crazy amounts of money, even if as you're getting more stable, and even if you're in let's say you're 30 years old, you're retiring at 60, if you're someone who can afford to invest $500 a month, that'll still get you to $1 million. Now, I'm not saying $1 million is end all be all, but when you're hitting 60, it's not like you're pulling all of your money out of retirement as soon as you hit that retirement age. You will still be investing your money for, even if you're in a position where you're getting older, can't manage it yourself, you get someone to manage your portfolio for you. They will still be, hopefully, ideally taking on some less riskier assets, such as more of a high yield savings, more of a bond portfolio, so that your portfolio is still seeing gains. Because the last thing you want is to be in retirement age having 100% of your portfolio in stocks and equities, and then where you see something like the Great Recession, or even now today, where your portfolio is going to dip 30 to 50%. Because having to sell your portfolio at a loss or in a downturn is just kind of just setting you back years of growth, and all that hard work and time and effort can kind of just get washed away. So it's good to help diversify into some more less riskier assets as you're getting closer to retirement age. But if you're someone who has a long-term time horizon, you have time on your side, that's where you want to be a little bit more aggressive, stock heavy, with even with something like an S&P 500 index fund that keeps it simple and easy, something you can auto invest in every month and just watch your portfolio grow. And I think that's really important to understand, that time is on your side if you use it properly. Now, I'm not trying to say if you have an upcoming down payment on a home in a few years to invest your money in stocks. That could potentially work out very well for you, or it could be very poor decision, because if the stock market dips, then you would have been better overall on something like a high yield savings or even a CD. I didn't include CDs on this. CD rates typically are in between a high yield savings and a bond on average. And CDs are nice because if you have the money now and you know you're going to be buying something in the future in like 3 or 4 or 5 years, whatever it is, you can throw that money into the CD, let it compound at its rate, and then you're guaranteed that return at the end of the CD. Bonds behave in a similar manner. There is a risk of default with bonds, though, if the underlying writer of the bond declares bankruptcy or defaults on that bond, you lose the money that you put in. So there is, as you're taking on these higher returns, you are getting more risk associated with it. It's always good to keep in mind, and don't just go with the highest yield bond product that you see available or the highest dividend paying stock, because that may not be a good indication of how strong that investment opportunity is. So, summarizing everything I just said, this is a tool I created that I will upload, where you can play around with your initial contribution amount, your monthly contributions, and then how much time you have to invest. And you'll see that as you're getting older or closer to retirement, you will have to invest more to try and compensate and catch up. So really, it's better to invest less when you're young, so that you don't have to invest more when you're older to try and catch up. So those small contributions can really add up over time. And you can play around with the interest rates to see what the returns look like. Basically, this is converting this calculator, which you only can do one investment at a time, to input a bunch of different ones at once and then compare them. Hope you guys found this helpful. I'll be providing links to both these tools in the description. There's also another tool called Portfolio Visualizer where you can backtest different like essence stock market, cash, like similar to this. But I will not be going through it. I've talked about it in some other videos. I'll provide a link for that in the description as well if you're interested, as well as a link to view or download this Google Sheets file. So hope you found it useful. Hope that this information made sense. I'm personally in my lower 20s, so I have a lot of time on my horizon to invest, and I'm definitely taking advantage of investment opportunities for the long run. So that's why I am stock heavy. Your situation may be different, so it all comes down to make sure you do your own research. It's good to be financially literate about your own financial situation so that you are aware of what you could do with your money and understanding that time value of what that money could be worth doing something else. So if you enjoyed this video, feel free to leave a like, comment, and subscribe if you want to see content like this in the future. If you have any content suggestions or feedback, feel free to leave a comment below. I'd be more than happy to take a look. Thanks for watching, everyone. Hope you enjoyed. Have a great one. Peace out.